Hello everyone. When it comes to stock investing, majority of people are divided into two camps. On one side, you have long-term investors who buy fundamentally strong companies at decent valuation for say 5-year, 10-year or even beyond. Their goal is to create long-term wealth via compounding. This is more of a Warren Buffett kind of style. On the other side, you have short-term investors who think that long-term investing is more of an old school concept. You need to follow the trend, identify themes or sectors that have a tailwind with strong earning growth, ride the wave, make good return in the short term, let's say 3 months, 6 months, and exit. Again, identify the next sector or themes and repeat. Basically, ride the momentum. You call it swing trading. Now, I've been following a lot of fund managers and over time, I've tried to identify their investment style. For example, Parag Parikh FlexiCap Fund, which is a very popular fund with AUM of more than 1 lakh crore rupees, they completely follow a value investment style. They buy quality business at fair valuation and hold them not for a few quarters but for years. In fact, they even do contra investing where they identify fundamentally strong companies that have corrected significantly. On the other side, you have mutual funds like Motilal Oswal Mid Cap Fund, which is again a very popular fund, but it follows more of a momentum investing. The focus here is on growth. They don't mind paying a premium valuation for growth. Obviously, you can't say that one style is right and the other is wrong. Both have their own ways of making money. It's just that you need to decide which style works best for you. Likewise, I've analyzed the investment style of many ace investors and I found that they don't pick one side. They actually combine both long-term with a flavor of momentum. They have what I like to call it a core satellite approach. So in this video, we'll first discuss the pros and cons of long-term versus momentum investing and then focus on how you can build a balanced approach with a core versus satellite portfolio. However, today's video is more focused on momentum style of investment where the question is, how can you identify the next sector or theme that can create wealth? I've tried to create a framework around it. Alright, let's get started. Let's start with long-term investing. Here the idea is to pick companies with solid fundamentals like strong management, competitive moat, long-term growth drivers and reasonable valuation. In this style, you are not worried about short-term market noise. That gives you a peace of mind because you don't need to track the market every day. Your goal is compounding wealth over time. But the catch is, long-term investing feels boring. Sometimes it feels like you're moving slowly while others are making big gain in the short term. For instance, if you look at portfolio of Parag Parikh FlexiCap Fund, its top holding include boring names like HDFC Bank, Power Grid, Bajaj Holding, Coal India, ICICI Bank, ITC, Kotak Mahindra and so on. Majority of retail investors want excitement in stock investment and value investing seems very boring. But the fact is, real wealth creation journey is actually boring. Another challenge is every business is cyclical. Some are deep cycle and some are shallow cycle. So it may happen that you invest in a company for the long term, but it underperformed during a specific period of down cycle. And that's where it gets very challenging. Long-term investing requires a lot of patience. And if you don't have the right knowledge, you will panic. That said, the real wealth is created in long-term investing with compounding. Here, please note that long-term investing does not mean you buy and forget. You still need to track the business because every business has certain risk like your competition risk, execution risk, regulatory risk and so on. And sometimes management overpromise and underdeliver. So if your investment thesis does not work, you may need to exit. For that, you need to track the quarter results and read the con calls. Since it gets difficult for a retail investors with job or business to track the developments, I try to add value with my weekly video series where I track the quarter results of more than 200 companies and identify investment opportunities. I also share my own investment strategies. For more detail, you can explore my website or join button of this channel. Please note that I also track sectors or themes that are in momentum. That takes us to the second investment style, that is momentum investing. Momentum investing is all about identifying sectors or stocks that are outperforming maybe over the last 1 month, 3 months and 6 months. The advantage is this style can generate faster return if you can identify the right trends at right time. But it's not a perfect investment style. Momentum is cyclical. It works beautifully in trending market but struggle in sideways or choppy phases. Also, it can be very stressful as it requires consistent monitoring. So if you're not careful, one sudden reversal can hurt your portfolio. For instance, during the beginning of 2025, when market fell down badly, Motilal Oswal fund tanked much more than the mid-cap index. So momentum investing may sound very exciting. It's very much volatile as compared to value investing. But of late, I've observed that majority of new investors in retail are looking for quick money via momentum investing. Now the question is, if you can make quick money with momentum investing, why not just focus on momentum then? Why even bother about long-term investing? The reason is because a lot of retail investors fail to identify the momentum at the right time. Majority of people end up investing during the ending phase of momentum where the sector or theme has already run up a lot and valuations are too high. And that is a recipe for disaster. The key to momentum investing is not just right entry but also right exit. It may look easy in hindsight but extremely difficult in reality. For example, last year I clearly remember everyone was going gaga about the railway sector after it already jumped a lot. And when the entire sector tanked, a lot of people ended up in losses. And that's where the core versus satellite approach comes in. The core portfolio includes long-term holdings that can compound your wealth. And satellite portfolio includes stocks or sectors in momentum that can give quick returns. You need to make a fine balance between core versus satellite portfolio. Again, it depends upon your investment style. Personally, I like to keep 70-80% exposure in long term and rest in momentum. I'd love to know your percentage allocation in momentum versus long term in the comment section. Now, once you understand this concept, the next step is to learn how to actually identify sustainable momentum. Which sectors are showing strength, which stocks are leading, and how to know when to rotate out. That's exactly what we are going to discuss in the next section with a framework. So first step of momentum investing is to identify the tailwind. Every strong momentum starts with a story, a clear macro or micro tailwind. Now, how do you identify the tailwind? For that, you need to keep your eyes and ears open. Basically, you need to stay updated with all major developments within the economy. For instance, a massive tailwind comes from government policies. Indian government focus on Make in India and Atmanirbhar Bharat has created a massive tailwind for defense sector of India. Many stocks in this theme have generated multi-bagger returns. Then government focus on railway modernization in the past resulted in huge growth in railway sector stocks. The electronic sector has seen many multi-bagger stocks due to government push for Make in India and PLI scheme. Recently, there's a huge focus on the semiconductor sector. Now, the government focus is also shifting towards consumption. And recently, after the GST rate cut announcement, auto sector has outperformed by a huge margin. Another way to identify the tailwind is closely following the shift in consumer behavior. This is more from long-term investment perspective. For instance, today many consumers are moving from unorganized market to organized market. So premiumization is a huge tailwind. One of the strong beneficiaries of this trend is alcohol beverage sector of India. Then retail sector like gold retail has outperformed in the past. Then another consumer shift is technology usage. With increasing internet penetration, cheap data plans and smartphone penetration, technology companies of India have a huge tailwind. Right from online purchase to buying food or grocery online or maybe investing money online. It has resulted in huge growth for internet companies in India. And this is one trend that I expect to continue for a very long period. I have discussed all these themes, premiumization theme, alcohol beverage sector of India, internet boom and platform companies in the previous videos. Then another huge trend is financialization of saving. Today, more and more people are investing their money in equity and mutual fund. That's where the entire capital market sector, right from wealth management to AMCs to exchanges, are bound to do well for long term. I've again discussed capital market sector and wealth management sector in detail multiple times in the past. Then there are some sectors that are cyclical. For instance, real estate sector witnessed weak growth before COVID, but then we have seen a strong upcycle. Likewise, hotel industry has seen a very strong upcycle post-COVID recovery. So if you can identify the sector where the upcycle has started, it can help you create good wealth. Then second step in momentum investing is to confirm sector leadership. Once you got the tailwind, check which sectors are actually showing strength. For instance, when GST rate cut got announced, it was for all consumer facing sector including FMCG, consumer durable, travel and tourism. So every sector was expected to benefit from consumption space. However, auto was the biggest beneficiary of this rate cut. Now, how do you know this? For that, you can check the performance of each sector versus Nifty 50 or Nifty 500. For instance, you can visit NSE India website and get the percentage detail of each sector or theme versus broader market for 1 day, 1 week and 1 month. Just download the data and calculate the percentage return. If the sector is showing higher return versus Nifty for let's say 1 month, 3 months, 6 months, it shows relative strength. Personally, I have a dynamic Excel sheet that gives a clear idea about sectoral performance. For example, here you can see Nifty 50 return over 1 month, 3 months, 6 months and 1 year. As compared to that, Auto has outperformed big time in last 3 months and 6 months. Right now, PSU banks and private banks are showing relative strength in last 1 month. IT has been the biggest underperformer in last 1 year. Likewise, you can also visit TradingView website and compare each sector's performance over multiple time frame. You can also confirm the uptrend on screener by looking at basic technicals like whether the index or stock is trading above its 50-day moving average and 200-day moving average. If the sector index or stock price is trading above both its 50-day moving average and 200-day moving average, and more importantly, the 50-day moving average has crossed above the 200-day moving average, that's what we call golden cross, then it signals the medium-term trend, that is 50-day, has turned stronger than the long-term trend, which is 200-day. And when this happens across multiple stocks in the same sector, you can be almost certain that a sector level momentum is forming. For instance, Nifty Bank Index is clearly trading above its 50 and 200-day moving average, and golden cross happened in April month. Nifty Auto Index is also trading above its 50 and 200-day moving average. Nifty IT is showing good momentum in last 1 week, but technically the index is still trading below 200-day and 50-day moving average. Another important way to identify sectoral or stock level momentum is by looking at stocks that are at 52-week high. Now usually investors think that if a stock has touched 52-week high, then it is expensive. On the contrary, for momentum investing, identifying stocks at 52-week high can be a great starting point. You can simply visit Screener, look at each index, say Nifty 50, and sort stocks bowed down from 52-week high. Here at the moment it clearly looks like NBFC and banks are leading in Nifty 50. Similarly, you can do it for mid cap, small cap and micro cap index. Then third step is identify leading stocks within that sector. So once you have spotted a sector where the wind is clearly blowing in one direction, the next question is, within this theme, who is leading the race? Because remember, in every bull run, not every stock runs equally. Leaders create wealth. Followers only create noise. So how do you really identify the leaders within that sector? First way is by checking the relative strength. Once you identify sector leadership, you can look at the relative strength of each stock within that sector. It simply compares how a stock is performing versus its index or peers. So let's say you identify that Nifty Bank is showing good momentum. Now you can simply visit Screener website and identify all the constituents of Nifty Bank and then check which stock is showing relative outperformance versus Nifty Bank. On Screener, you can see which banks are showing more strength with higher return. By the way, if you don't find this 1 month return metric, just add it by editing the column. I also use a dynamic Google Sheet that gives me a clear picture in terms of which stocks are outperforming across index in last 1 month, 3 months and 6 months. Then second criteria is by checking volume action. One of the biggest mistake retail investors make is they get excited just by seeing a stock going up. But in markets, not every price rise is real momentum. Sometimes it's just a low volume move, a few trade pushing the prices higher. That's why serious investors always look for volume confirmation. You can simply compare the average volume of 1 week versus average volume for last 30 days. On Screener end, you can get the clear idea on volume confirmation. Here there is a clear volume confirmation for banks. Then third, you should check the earning momentum. See, sustainable momentum is not built on charts alone. It must be backed by fundamental, that is earning growth. So always check, are quarterly revenues and profit accelerating? Is the company gaining market share? Are margins expanding? If fundamentals and technicals both are lined up, you have found a high conviction leader. For example, post GST cut announcement, auto companies clearly mentioned that the inquiry has increased a lot and festive season has witnessed bumper booking. And that should get reflected in the upcoming Q3 results. Then fourth is to check the narrative validation. Always listen to what management is saying. Look at the investor presentation, con call and order book that provides the update that reveals if the tailwind is actually translating in the real business or not. So when number, price and narrative all point in the same direction, that's leadership. In a momentum wave, 20% of stocks drive 80% of return. Find those 20% by combining relative strength, volumes and earning momentum. Then fourth step is ride the trend. The biggest mistake momentum investors make is they try to outsmart the market. They book profit too early or they start shorting the moment the stock looks expensive. But remember, in a trending market, expensive can become more expensive and stronger can stay strong for much longer than you think. Momentum investing is not about prediction. It's about participation. You don't need to be the first one to enter or the last one to exit. You just need to ride the middle of the trend, that sweet zone where the probability is on your side. Now, once you identify the strong sector or stock, don't overthink where it should go. Instead, let the trend guide you. You can simply use moving averages to get the trend. For example, if the stock is consistently trading above its 50-day and 200-day moving average and both lines are sloping upward, that's a clear sign the trend is intact. You just ride it until the market tells you otherwise. Then fifth step is know when to exit. The most critical part of momentum investing is right exit, because momentum does not last forever. Every rally, no matter how strong, eventually slows down. And if you can't recognize that, you end up giving most of your gains. So how do you know that momentum is over and it's time to exit? So first option is look at the relative strength. If it is weakening, then that's a clear sign. When your stock or sector starts underperforming the broader index, let's say Nifty 50, it means institutional money is moving elsewhere. That's a quiet but powerful signal that momentum is rotating out. Second is look at the technical breakdown. If the stock falls below its 50-day moving average and stay there for a few sessions, that's a sign that momentum is fading. If it breaks 200-day moving average, that's your cue to exit or reduce exposure. For example, after an extraordinary rally, KPIT share price fell below 50-day moving average and 200-day moving average, and then 50-day moving average fell below 200-day moving average. That was a clear sign of momentum breakdown. Then sixth step is review and rotate. See, momentum investing is a game of rotation. The market always has a few sectors in momentum and few losing steam. Your job as a momentum investor is to keep tracking where the money is flowing. So how do you identify where to rotate the money? For that, you need to again follow this step 1. That is, identify the next tailwind and sectors that are showing relative strength. For example, at the moment, the sector that is showing strength is banks. So to sum it up, momentum investing is all about following a structured approach. Step 1 is identify the tailwind. Look for macro trend, government policy, consumer behavior shift, or cyclical upcycle that can propel a sector forward. Second step is confirm sectoral leadership by checking which sectors are outperforming the broader market using your relative return, technicals like DMA and Golden Cross. Third step is spot leading stocks. Within a strong sector, identify leaders using relative strength, volume confirmation, earning momentum, and narrative validation. Next step is ride the trend. That is, participate in the trend and stay disciplined. Next, it is important to know when to exit. Track weakening relative strength and technical breakdown and other signs of momentum fading. And finally, review and rotate. Keep scanning for the next tailwind and rotate into the next winning sector or the theme. Remember, momentum investing works best when you combine with a core satellite approach. Your core portfolio ensures long-term wealth creation, while satellite let you find those short-term opportunities. Follow the framework, stay disciplined, and let the market trends do the heavy lifting. Now tell me in the comment which sectors you find most promising in current market that are in momentum. If you find this video useful, do share it within your circle. I'll see you next video. Till then, take care.